So we talk about this industry, very interesting industry, very tax-driven industry, very actuarial science-driven industry. It does have a specialization there. Investment-heavy industry, unlike the property and casualty side, as far as the involvement of the actuaries. It is its own industry. So it is, if you're a life insurer, you're a life insurer. There's no doubt. It's not like Walmart does life insurance on the side or Google Alphabet does life insurance on the side. We'll talk about it a little later when we talk about antitrust. Microsoft can't go out there and just sell one life insurance policy so it gets exemption from federal antitrust laws. You have to be, if you do life insurance, you do life insurance, you do a lot of it. It's a very, very concentrated industry. And because of that, it has its own little websites. We'll talk about the NAIC some here a little bit later. But the NAIC is the main regulatory body of this industry. It's not an actual regulator. What it is, it's a group of regulators from all 50 states who get together and to devise laws that then they try to get the states to adopt. And we'll talk about the model risk-based capital law, the model investment law. We'll talk about those in this class. So the regulators are from every state. The key regulator is on the NAIC. The industry is heavily involved. You can see the type of categories they have. Security evaluation, market conduct. This is something we're going to talk a lot about in life insurance. Is a huge issue for life insurance. Structured settlements is a big part of this industry. So the consumer committees, boy, the committees, you can just see what kind of things they're working on. I had a boss that this was like 30% of his job was to try to, he was essentially a lobbyist. He knew these regulators backwards and forwards. I could tell when he called them that they really didn't want to talk to him, but he knew his job and he would call them. I remember calling the insurance commissioner of New York State and just, hey, this is so-and-so, how you doing? And the guy's like, oh, why are you bothering me again? But he got what he wanted out of him. And he got it because he would volunteer my time to do all kinds of free work for them. And they're like, okay, we need that guy that you work 7 days a week to do stuff for us. It'll be nice to you. But it very much is the industry and regulators working together. It's supposed to be independent, but the regulators can't do anything with that industry because they don't have the workforce to do it. So it's a pretty interesting relationship. A lot of really good resources there. AM Best is, I keep hoping we'll have an actuary or finance major go work for AM Best. It's a wonderful company, very much like a USA kind of, or at least the way USA was when I was there, very collegial campus type event. I've been to their campuses. It reminds me a lot of USA, or maybe like HEB is here when HEB was downtown. Very friendly place to work. I don't know if they have jobs. Do they have a job? Careers, there you go, careers. I don't know the kind of people they actually hire. I'm sure they have actuaries because I've met some of their actuaries. You can see, doesn't that look, kind of remind you of a USA? Almost the same building. So they rate insurance companies. That's what they do, which means they know companies extremely, extremely well, have a lot of industry knowledge. So working for AM Best for a couple of years would look great on your resume to move back in industry. If you're studying for the actuarial exams and you need a place to work to learn the industry, it'd be a really great place to do your starting. They have a magazine that the UTSA library used to have. I don't know if they still do, but it's a really, really good magazine. We're going to talk about some of the stuff that they produce. I think is very, very helpful. Great company though. I used to present to them and always enjoyed presenting to them. Just a really friendly group of people. ACLI is a group, you probably, if you're an actuary, you want to go look up their website and just search around to see what they have. It's the American Council of Life Insurers. Essentially a trade organization, lobby group for life insurers. Discover the industry, diversity, inclusion, paid family, so you can talk about them themselves. They have some industry facts, what's going on in news events, but it's essentially a good place to go if you want to know what are the key issues that I should be thinking about before I go interview for a job. SOA, everybody know what that stands for? You actuaries?
Society of Actuaries.
Society of Actuaries, yeah. So Society of Actuaries, very focused on the life insurance side. There you go, future actuaries, right? That's some of y'all in here, or are y'all present actuaries? What are y'all? Education exams. So yeah, there's a lot of stuff here you could certainly do. I think we talked about be an actuary. .org. Y'all probably actuary majors probably are using that site quite frequently. It is be an actuary. It's not being actuary. It's be an actuary. So get this actuary profession, get you started. Look right there, right off from the start. They have math problems. Like actuary is something I had a friend call me about a career for their high school student, and he told me what she was doing, and I go, why don't she just become an actuary? That sounds like the perfect career for her. She was doing all this stuff, spending a lot of time and effort to become like a high school math teacher. It's like, you want to do math, but get paid a whole lot more money, not have to deal with a bunch of high school kids. It's like, doesn't that sound like a nicer life to you? Just being a high school teacher appeal to anybody? It's just like, kids are going crazy these days. It's like, why don't I get paid 3 times more and not have to deal with the kids? So they said, I had never heard of that. They had never heard of it, right? No one, what is an actuary? I don't know what an actuary does. Like, hey, you deal with death and dying all day long. It's really cool. So plenty of resources. All right, let's get into, all right, this is one of my favorite topics. All right, whose toes am I going to step on? Michael, you got to tell me if I'm stepping on toes. So go to work tomorrow and tell them what I said and see how many of them say, you got to drop that class, man. All right, so why do I so dislike this industry? Why do I have such a negative vibe with this industry? So this is an exam question. On the exam question, I specifically say you don't have to agree with me, but I do want you to present my arguments. If you want to waste time on the exam and present your arguments, that's perfectly fine. I'll read it. I love that. See, you side of the argument, but you got to present my side of the argument, so at least know that you captured it and heard them. All right, so let me give you my side of the argument. My side of the argument is something radical happened in about 1980 that radically changed this industry and shifted it from being a life insurance industry to being an investment industry, heavily commission sale. So what happened in the late 70s? Well, this is an industry that was really boring. They sold, we're going to talk about term and whole life, but they sold traditional term type of insurance. You buy insurance for a few years. When you're young and you need it, it expires after, say, 10 years, and you don't need it anymore. You're happy. Our whole life, you buy insurance, you're going to pay $50 a month until you die. So you just pay and pay and pay. When you finally die, it pays you back. Very, very simple products, very easy to understand. Most people know, hey, I've got a 5-year term policy. I'm going to pay $50 a month. If I die in the next 5 years, I get $100,000. If in 5 years I'm still alive, I can go buy another 5-year policy or just let it expire. That's very simple, isn't it? If you're buying a traditional term policy, you have 3 companies. One charges you $40 a month, one charges you $50 a month, one charges you $60 a month. What would you buy? 40. Is that very hard to understand? If you die, you get $100,000. You can pay $40 for that, 50 or 60. Really simple. Whole life. You're going to pay the same premium for your entire life until you die. What's the only thing you care about? How much is the premium? You buy the cheapest one. So simple. Well, the problem was that worked really well in the 60s and 70s, but then suddenly interest rates shot up really high in the late 70s. And people are going, whole life is only paying me like 3%, 4% interest. I can get a lot better than that. And then the stock market started taking off, and people are going, why would I buy a whole life policy paying me 3-4%? Well, I can buy a bank CD paying me 15%, which I literally had a bank CD paying 15%. And I can invest in the stock market that's making me 12-13%. Why would I buy this boring whole life policy? So have y'all heard this term before? Disintermediation. It has to be in your answer on the exam. Very, very important. Anybody know what that means? What does disintermediation mean? What's another term for banks and insurance companies? They're financial what? Intermediaries. So does that help you with disintermediation? So disintermediation means when you fire one intermediary in order to hire another one. You fire a life insurance company and you hire a bank. You fire a life insurance company, you hire an investment firm. That's disintermediation. So the life insurance industry, because of the high interest rates and the strong stock market, they started losing a lot of money to banks and to investment firms. And it got really bad for them because what some were doing, let's just talk about whole life. I don't know if this recording is working any better. If anyone's on the recording, you can't listen to the sound anyway. Echo. Let's say whole life is paying you a 4% interest. And you can borrow from your policy at 4%. Bank CDs are paying 15%. And so people, especially financial advisors, looking at that and going, okay, you got life insurance. If you die, you get $100,000. And your cash value is $30,000. You could surrender this policy, take your $30,000 and go buy a bank CD, or you can leave your policy in place and borrow your cash value. You can borrow your $25,000 from yourself. And where would you put that $25,000? In a bank CD. You still have your life insurance. Now, if you die, you'll get $100,000, but you have to pay the $25,000 back. But you don't care about that because you've got it sitting in the bank anyway. Right, so you can get either way. You can make 15%. So what were people doing? They're borrowing from the life insurance policies at 4%, putting it in bank CDs at 15%. Insurance companies are just getting crushed. All this money is coming out of insurance companies. So that's a disintermediation. And these products were fine forever because no one really cared. And then the stock market just started taking off, and boy, the 80s and 90s, that was a great time to be in the stock market. Let me tell you how good it was. When we had to come up with assumptions for what we thought stocks were going to make going forward, we were making assumptions like 13%. You wouldn't do that today, would you? You'd love to make 13% in the stock market going forward. You know, today people think 7-8%, but back then the stock market was making double-digit returns for so long. We just started assuming we're going to make double digits forever. And the other thing that happened is 401k plans suddenly started taking off. And so people are just like, well, I don't want to buy a boring life insurance policy when I can put my money into this high rising stock market. All right, so that's bad for an industry. What should have happened? The industry should have just shrunk. Too many players, too much money. This industry is really past its prime. People still need term insurance and whole life, but they don't need this much of it. So let's just shrink. And guess what the insurance company said? No, we're not going to shrink. We're going to stay around and we're going to play this game. All right. So there's excess capacity in this industry. It should have shrunk. It should have consolidated. But what did it do? All right. So here's how it handled it. It's a pretty impressive story. This is not a stupid industry. So their reaction was complexity. That's a big part of the answer. They said, how do we get consumers to buy our product when we know our product's not as good as what the banks and investment firms are offering? Bank CD is very easy to understand. You know exactly what you're getting, 15%. Mutual funds, you know what you're paying for, you're getting the stock market. What can we can't compete with those. We're going to get down here to this next thing. Why can't they compete? Because life insurance is an extremely expensive business to run. They have actuaries, they have investment professionals, they have regulatory affairs people. They've got whole armies of people banks and investment firms do not have. It's a very expensive business. Their expense ratios are much higher than expense ratios of banks and insurance companies. They cannot compete in this business. But what they said is, hey, if we make our products so complex, our customers won't know they're not getting a good deal. Does that seem like a good way to go? It's smart for the industry. So we'll talk about this asymmetry of information. I'm going to give you examples of this complexity. You're going to be pretty shocked. We're going to study one in particular, the equity linked annuity and equity linked life insurance, just how incredibly complex these products are. So make sure you have this in your notes. The insurance industry has a huge disadvantage when it comes to cost. Very expensive industry to run. What's their advantage? Their advantage is one huge advantage they have is the tax code. These complex products did not improve their tax efficiency. So it's not like they're offering new products that are more tax efficient. They're just as good as the previous ones, and sometimes even worse. We're going to see. And essentially what you're going to discover is their expense disadvantage more than offsets their tax advantage in most cases, especially with these more complex products. Now, I'm not telling you actuaries don't go work in this industry. The reason it's more expensive is because they're doing stuff these other industries can't do, which is primarily one thing. It's paying people money based on when they die. Banks don't do that. Investment firms don't do that. You better have an actuary if you're going to do that, don't you think? You're going to tell someone, hey, you have this product for the next 50 years and we'll pay you when you die. You better have some good mathematicians to figure that out, because that's a pretty complicated thing to figure out. A bank finance person is not going to be able to figure that out. So you got to understand mortality tables and all kinds of important. We're going to do this in this class. How do you combine a mortality table with discounted cash flows? So you need those people. It's so expensive. So what does the IRS say? Hey, this is a product that only you can sell, and we're going to get some massive tax advantages to do it. And the industry said, great, we'll sell term and whole life. We'll take advantage of that. That worked really well until the 1980s. And they said, okay, well, let's hide the fact that we're not competitive by producing products nobody can understand, including the people selling it. A product so complex, even the person selling it can't explain it. Now, I said their main advantage was the tax code. They do have one other advantage that these other industries don't have, and that's how they pay their salespeople. Sales commissions. You go into a bank lobby to buy something, it's not a very hard sell. Why? Because they don't get commissions for selling you stuff. Now, on the investment side, yes, there are commission sales, and you have to kind of watch it there, but not nearly like life insurance. So these products are incredibly complex when it comes to the product, but what's not complex is the commission. You walk in with $1 million to buy a product that has a 10% commission. Do you think that sales rep can do that math? 10% times $1 million. Think they can do that math? They can do that pretty fast. Do you think they're smiling while they're doing that math? Any of y'all want a $100,000 commission? Does that sound like a kind of a nice thing to get before you go home for the weekend? Say, hey, I think we'll go to Europe this weekend. And also conflicts of interest. What is the conflict of interest? Product A has a $50 commission. Product B has a $500 commission. Company Do what is best for the client. Does that model work? All right, salesperson, here's 2 products. We'll pay you 10 times more if you sell this product, but make sure you do what's in the best interest of the client. Do you think that model works? What is this salesperson going to sell, do you think? Product B. Is that because they're unethical and evil? No, they're going to look at the 2 products and say, you know what? I really do think product B is the better product. They really believe that? Remember what I just said. The product's really complex. Do you think you could have a really complex product in your mind think, you know, I think that's better for the customer? If it's impossible to do the math, to be able to tell if it's better for the customer, do you think you could convince yourself B is the better product? I think you probably could convince yourself. Is a 10 times higher commission enough to convince you to convince yourself? I would think so. Yeah. Can any business be run ethically with that type of mathematics? Can you really tell your salesperson do what's right? You're going to pay them like that. That's why when the lady from that life insurance company says, yeah, but we base the commission based on our margins. What did she just say? We pay $50. Why? Because this product is not as profitable as this product. Do you think that solves the problem? I think it makes it worse. Because now not only does the sales rep have an incentive, now the company has an incentive. So I don't think that makes it, I don't know why she was telling me that, like, no, it's based on margins. It's not based on, yeah, that's the problem. It's based on margins. What if they did this? Product B is a more profitable product for the company, but they have the same commission for both. I'd be fine with that. That wouldn't bother me so much. But they do this. Why? Because they make much, much more money. And sometimes we're talking this. Now, I ask you, if a company is going to pay their worker $50 on one product and $5,000 on another product, can they give you the same benefit in both products? Don't they have a problem right now? They just give their sales rep $4,950 extra money. Where's that going to come out of? Do you think the company's saying, hey, you know what? We'll just not make money. We'll just overpay our sales rep. You think that's what they're thinking? Where's that money coming from? It's got to come from you, the customer, doesn't it? There's no other place for it to come from. So if they're paying a much bigger commission on one product versus another, they must be taking more of your money on that product than they are in the other product. There's no other way to get it to work. So it's a very horrible model. Now, do other industries do this? Yeah, I'm sure when I buy a car, I'm getting ripped off. There's no doubt in my mind. That's why my last car I got from Carvana. Imagine, okay, if they're going to rip me off, at least there's no negotiation. Why not? I don't feel, my plumber always rips me off. My last plumber experience. And I rationalize it that I've got a lot of money, so I don't care. And secondly, they're going to buy products from my industry and we're going to more than rip them off in my industries. So we're even. That's kind of my logic. I don't like haggling on anything. I just can't do it. So like, okay, I'm a patsy, take advantage of me. But yeah, this industry, boy, poorly commissioned, poorly incentivized. Now, it was interesting at USAA. USAA still doesn't pay its reps commissions. I've been hearing rumors. If someone hears that change, they do not pay commissions. And I remember my boss so upset because the sales reps wouldn't sell more product B. And I said, they're not going to sell more product B because they know A and B are the exact same product, except A is a lot cheaper. And they know if they sell B, in about 9 months, that customer is going to figure it out. And they're going to call back and complain. They have no incentive to sell B. They're really smart people. They know the 2 products. There was one place where I was selling the exact same product. One costs almost nothing. The other one costs several $100s a year. And the sales rep sold the better product. And my boss says, why do they do that? We make much more money on the other product. And they knew, these salespeople, they understand, and they sold a better product. Not because they're better people. It's just, they don't want the hassle of selling a bad product. They're going to sell a better product. They have no incentive. And I don't know how to tell my boss. They just know it's, and he said, no, the second product's better because we send them this glossy once a quarter. It's like, they don't want that glossy. And do you want to spend $500 a year to get a real pretty glossy? And they're saying, but we give them better service. We don't give them better service. It's the same service. It's the same product, just cheaper. So he couldn't figure it out. Now, what if we started giving those people a big commission? Do you think they would start selling product B? I bet they would. I bet they would. They convince themselves, yeah, that glossy we're giving them extra service. Yeah, that's worth that extra $500. They would convince themselves. I don't think they're evil people. I think they would actually rationalize in their mind, yeah, we're really doing the right thing. I think that's just the nature. And here's my bottom line. You don't ask a sales rep, do what's right, but I need you to choose between your family and your client. Do you want your kids to have nice clothes and a house and food to eat? Or do you want to do the right thing for your client? I don't think you ever ask a worker to make that choice. I think it's a horrible choice. If I were a worker, I would think, my family likes to eat. Maybe I'll sell product B. Now, what else comes with product complexity? Y'all interrupt me if I'm stepping on toes here. What else comes with product complexity? This is one of my biggest pet peeves. This is going to come up later. We're going to talk about this later when we compare term and whole life as well. It's extremely difficult to compare two products when they're this complex. In fact, you might change this word. I say difficulty. I actually think for some of these products, it's actually mathematically impossible. Maybe if you have a PhD in math, you could handle it. Maybe I think at some life insurance companies, the actuaries are probably the only ones who can do this. The salespeople actually can. If you read my blog, I have a blog on this. I go into some detail on how complex. I'm going to show you some examples later about how complex this is. And it doesn't even have to be on the extremity of complexity. I'm going to show you a product my parents bought. I'm going to show you that product probably shouldn't be sold to the retail market. And it's not on the far end of complexity. It's actually kind of middle complexity. You can't comparison shop. Now just talk about term. Very easy to comparison shop term. You get $100,000, you die. What's your monthly premium? Piece of cake. Anybody can handle that. Whole life, very easy. You can get $100,000 when you die. What's my premium? Very easy. But I'm going to give you some examples, especially when we talk about equity-linked annuities. You're going to see those products. Just to give an example, we're going to see there. These are products that are tied to the stock market. You might have one product that has 100% participation and another company whose participation is 50%. Which would you rather have? 100% participation in the stock market or 50%? Most people say 100%, wouldn't they? But then you read how the 100% is calculated and you discover that the 100% actually gives you less of the stock market than the 50%. Does that make sense? Because one's a point to point and another one is an average. But just because of the way they define how that 50%, 100%, the 100% is actually the worst deal. But if you're a sales rep and say, hey, our product has 100% participation, that sounds pretty strong, doesn't it? Does that seem fair? Doesn't that seem like cheating a little bit? So they say 100%, but we'll change how it's calculated so it's really worse than 50%. But I'll let our sales rep say this, we pay 100%. That's the comparison shopping difficulty. So what we'll see here just with universal life, how it's, even if universal life is simple of a product it's very, very difficult to comparison shop. Now, is that true with your auto insurance? Do y'all think you're getting ripped off on auto insurance? So what would you do in auto insurance? I say, okay, here's my part one. Here's how much I have, coverage I have. Here's my part D, how much coverage I have. I'm going to call it Geico and ask them for a rate. I'm going to call up Farmers, ask for a rate. You just tell them what you have, and what would you go with? Would you say, well, State Farm's 40% higher, but they got really good service. Is that what you're saying? How often do you need service from auto insurance whenever you have a wreck? How often do you have a wreck? Hopefully not very often. Do you really care if they give you good service? Wow, State Farm calls me back in 10 minutes, but Farmers, it takes them 12 minutes. I'm going to pay the extra 20%. No, you go with price. Very, very obvious. Homeowners insurance. You tell them how much coverage you want, what's covered. Go with the cheapest rate. It's really simple. It does. You don't need a PhD in math to compare those. Comparing two equity-linked annuities. If you got a PhD in math and you can create a 10,000 scenario stochastic model, you can maybe get an idea which product might be slightly better or worse. But how many retail investors can actually do that? Pretty tough. So difficulty comparison shopping. And then the sales practices and employee training. Companies say we tell our customers to do tell our salespeople to do what's best interest of the client. But it's wink, wink, but please sell product B. Right. I always word at USA. USA doesn't pay commissions, but they do have a little perks, like you get this trip to wherever if you sell more of this. It was tough at USA because they made a lot more money on whole life than they did on term, but their sales reps sold a lot of term, like 80%, 90% term, and they wanted to sell more whole life. Without sales commissions, they really had no power. So they started saying, hey, you know what, if you sell more whole life, I'll give you this trip to Hawaii or something. And like, that made me nervous. It's like, no, let's don't go there. Let's just sell what makes sense for the customer. And that creates these information asymmetries. You walk into someone's house to sell them a product that's really complex, but there's a sales technique. It works really, really well. You sell something that's really complex, but you talk about it like it's really simple. What will most people do in that situation? Someone comes to you and they talk and you don't have a clue what they just said, but they talk to you like it's really simple. What are you going to do? You're going to do this, aren't you? Does anyone want to look stupid? Say, yeah, okay, yeah, that makes sense. I see what you're saying there. People will buy stuff. And think about senior citizens. What will they do? They're lonely people. Are they going to say, no, I don't want to buy that? That's going to disappoint you. What are they going to do? They're going to buy it just not to disappoint the person. It's, it's just a horrible practice. The sales rep understands everything. They have all information. They know how to make the sell. They know what to talk about. I've sat in some of these. There was one where I almost beat the guy up. Poor guy. My brother was I told my brother, don't buy anything without me sitting there next to you, because he would buy the worst stuff. I get this on Zoom now, but he knows. So he invited me. Oh my words. I'll tell you what some of these people have said, because we're going to talk about this one particular company. It's like, I can't believe you just said that. That's just so unethical. I wish I had a video, because I'd love to have taken it to the insurance commissioner and just say, this is what they're saying in a meeting to people. There's no way that's true. There's no way that's ethical. I don't know if it's legal or not, but I just want you to hear. I wish I had recorded these secretly. Just shocking what they would say. Why? Because they get a massive commission and they love the commission. This one particular company has the best sales force out there. I know because they started hiring teachers and coaches, and my high school government teacher, I say professor, he's in a small room and he wore a mic with speaker. He wanted to be a college professor, but he was a high school government. He was one of their sales reps. He was selling us life insurance in high school government. That's how aggressive these people were. They were really good salespeople. They knew how to get this to work. Very aggressive. Why? Because I gave them commissions. The stuff they were selling was horrible products. I'm going to give you mathematical numbers because it's really shocking. The products they were selling were so horrible, but they were doing really good. They were selling a lot because they knew how to sell. The sales practice, the training, a lot of questions there. All right, let's get to the tax side. So the insurance industry has huge tax advantages. Well, here's how it works, and this makes me so mad. I'm going to give you Danya's story where you're going to see in a specific example. So they come in and they say, wow, this product has all these tax advantages. If you buy this product and this happens, it's tax-free, blah, 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 blah. 2 years later, the person discovers, wait, I don't think this is working. I think I messed this up tax-wise. So they call the company and they say, hey, you sold me on the tax benefits, but I think I set it up wrong, or your sales rep set it up correctly. And what does the company say? Sorry, we don't give tax advice. You have to call your tax attorney. How many people how many of y'all have a tax attorney in here? I don't. Any of y'all have tax attorneys? You have one on, on call. You pay them $10,000 a year. But that's what they tell you. You need to consult your tax attorney. Now, when they sold the product, do you think they said, this product is quite complex, you will need a tax attorney? Do you think they said that at the sales side? Of course not. What would happen if they said that when they're selling a product? He's like, what? I have to have a tax attorney to buy this product? So they say they push the tax advantages when they sell the product. But a day later, it's like, we don't give any tax advice. That's not our business. You need to call your attorney. I think that's unethical. Why is the IRS such a problem? Because IRS gives huge tax advantages by taking something away from you. What they take away from you is liquidity. These products are really hard to get out of. So if you change your mind, you don't like it, it's going to be really tough. Can you switch to another company? Yeah, you better be ready for some massive paperwork. It's really difficult to do. Or you may just not like the product at all. You say, you know what? I shouldn't have bought this really complex product. I want to buy a less complex product. You can't do it. The tax rules won't let you do it. The only way you're going to do it is by paying a massive 10% penalty in taxes. And at that point, it's just gonna kill you. So yeah. Do they have tax advantages? Absolutely. Are they valuable? They're tremendously valuable. But get this in your notes, because I don't think I have it really spelled out here. The tax advantages are actually better in the simple products than they are in the more complex products. You're just as good off with those tax advantages buying those simple products. And that's what you should stick with. The product complexity does not contribute to the tax advantages. It actually takes away from it. All right, everybody got that in your notes? I should probably add that to the notes. Let me add it here. Product complexities do not enhance tax advantages and often take away advantages. We'll see that when we talk about equity-linked annuities. They're going to make that point in the article that you're actually worse off with these products. So I love level term life insurance. I love whole life insurance. I think they're wonderful products. I think people should be buying them. They make a lot of sense. They're very simple, very easy to compare, and they have absolutely tremendous tax advantages. Stephanie, you've been talking about how the products are very tax. We're going to see it. I'm going to show you. So you have to just take my word for it right now, but I'm going to definitely show you. You'll see. We're going to read an article. I think I have it under miscellaneous. It's called equity-linked annuities. It's an old article, but it's so good, and the world hasn't changed since this article was written, so it's still just as good. But it's going to get into those complexities. And you're going to definitely see them. So this is what I'm talking about on the participation rate. There's 3 ways to do the participation rate: indexing methods, which are point-to-point methods, monthly average. I forget the third one. So I'll actually show you mathematically why one's the better one than the others. But I'll show you. This article is pretty shocking. So they have participation rates, they have caps, they have the way the crediting's done, the minimums, how they're expressed. So maybe Stefan, if I just show you, let me show you a simpler product. Let me do ULife. ULife, Universal Life. So don't put this in your notes yet because we're going to cover it later. Anybody heard of ULife, Universal Life? Was a really popular product back in the 80s. So it has an investment rate, say 5%. And when you sell Universal Life, that 5% is on the front of the market. That's what they push. Which product do you buy? Would you rather be paid 5% or paid 4.5%? Okay. The cost of insurance, the COI. $125, company A, $92, company B. Would you rather pay $125 for life insurance or $92 for life insurance? Well, but you have to pay $92, but they're only going to pay 4.5% on your cash value. So which one's better now? What would you have to do to figure that out? You'd have to know what interest rates you're going to do next 50 years. Anybody know that? How many scenarios would you have to run to be able to figure that out? The other thing is, they can change that rate at any time. Now, which would you rather have? Why are they paying 5% in September? But because September is the biggest month they sell these products, so they jack up their rate in September, and then in October they drop it. Does that seem fair? It's perfectly legal. They can do that. There's several other parts of this product that I'm not going to get into now, but Stefan, you see the point. You got the loan policy rate. You got the guaranteed minimums. What about the guaranteed minimums? Maybe that's 2% at A and 2.5% at B. Which would you rather have? A 2% minimum they're going to pay you or 2.5% minimum they're going to pay you? Well, if you never think interest rates are going to fall, you don't care. But what's happened in the last few years? Every life insurance company is hitting their minimums. So I'd rather have 2.5. I bought a product at UTSA that had a 3.5% minimum. And I thought it was crazy. They sold it in 2008. I asked them, why do you have such a high minimum? And they said, we're trying to hit our year-end goals. I said, okay, well, I'm going to buy it. And sure enough, when interest rates fell, I hit the 3, and I was making 3.5% when bank CDs were less than 1. I was like, this is kind of nice. So, but another product might be 2%. So Stefan, you see, you bring all these together. How do you figure out which is the best product? It's mathematically almost impossible. You have to run thousands of scenarios to figure it out because there is no one answer. Sometimes A is going to be better. Sometimes B is going to be better, depending on what the future is. So it's really tough. But I'll give you an example of Universal Life, especially my parents. I forget, I'll get you the actual numbers, but their monthly premium went from like $300 a month to $1,600 a month from one month to the next. Do you think that's a shock to have your premium jump 5-fold, 4-fold in 1 month? So, all right. So the complexities don't really help you that much. On the taxes, certainly help the salesperson. So the question is are these complex products any better than the simple products? And that's what we're going to see in the equity linked annuity article. That's what they did. Oh, did I already shut the article down? Did I click off of it, or is it still there somewhere? Oh, it's a Word document. That's right. So the comparison they did is 96.9% of the time, the investor is better off with buying treasury bonds and the stock market than they were with this index product. What does index product say? Hey, we're going to give you the stock market return without the risk. If the market falls, we're going to give you a floor so you don't lose money. But the market takes off, you'll get all the up. Now, actually say that you get all the upside without the downside. If I told you 96.9% of the time, you better be better off just going to an investment firm and investing in their products, which would you choose? But you might say, yeah, but 3.1% I'm better off. Well, in the 3.1%, when their product is better off, it's just barely better off. It's never a whole lot better off. Now, which product would you choose? I think I'd go with just investment firm. Why go through all this complexity for something that's going to win 3.1% of the time, and when it wins, it just barely wins? Doesn't make a lot of sense. How did he figure this out? They figured it out by running thousands of simulations of different stock markets, bond markets, and that's how they figured out. So the complexity doesn't give you anything on taxes, and most of the time it underperforms the simpler products. All right, we'll get into it. We'll look at it. And so this term stochastic dominance, what does stochastic dominance mean? That's what I just showed you. Stochastic dominance means you run thousands of simulations, and while one may not be right 100% of the time, it's right so much you might as well just buy the one that dominates stochastically. I think you actuaries have to take a stochastic class, don't you? Y'all take stochastics somewhere in your undergraduate. So running simulations, you just want to see what happens, because the math is so complex, you can't really, do an optimization routine. You just run 1,000 simulations, 10,000 simulations. And when you do that, you'll find out that the simpler products win the overwhelming majority of the time. The complex products win just a very small fraction of the time. Why? Because they're so expensive. You're getting so much of your money taken away from you. It just takes almost a miracle for these things to work. Now, there are some products that are a little less complex. They're still pretty complex. We'll talk about them. They do have tax advantages. What you discover, for the tax advantage to work, you have to hold a product like 25 or 30 years. If you don't hold it that long, if you sell it after 10 years, you're going to lose all those tax advantages. It just doesn't work. So you have to have a long time horizon. All right, what questions do you have on this? You got to kind of let it set in. You got to put this into your own words. You can't just copy and paste this into your answers. So something changed in the late 70s. What changed? Higher interest rates, stronger stock markets. Other industries within financial services started having major advantages. They could pay higher interest rates. They could get you access to the stock market. No one was thinking about stocks in the 70s. Especially after 73, 74, they're like, why would I want to buy stocks? But then suddenly in the 80s, stocks were really good. So this old, stodgy, boring industry, people are like, why would I invest in a life insurance company? Low interest rates, they pay me low crediting rates and whole life. They don't give me access to the stock market. I'm just going to move my money to banks, get high CD rates, or move my money to investment firms, get the stock market. The life insurance industry said, you know what? We can compete. We're going to give you higher interest rate products like universal life. We're going to give you products directly tied to the stock market, like equity linked products. We got you covered. And you look at it and say, yeah, but is this as good as the bank product, an investment product? And say, I think it's just, yeah, I think it's really good. And you ask questions like, well, and if you read my blog, there's questions you ask. How would this product have done if I'd held it from 1980 through 2000? How would it have done versus an investment firm? What's the sales rep going to tell you? I have no earthly idea. But wouldn't that be a good question to ask? How would this product have done if I'd held it in the 90s? What would you want to do in the 90s? You would just want to have the investment product because the stock market just shot up in the 90s. How would this product have done? Here's how it does versus the stock market. If you invest in the stock market, you would have made, well, let me do it up here. You invest in the stock market, this is over, what is that, 30 years? Stock market, your $1 would, or $100 would become 4,900. But these products don't give you the total return of the stock market. They give you the total return of the stock market, excluding dividends. You take dividends out. If you invest in a stock market without getting dividends, your $100 would have only been worth $17.68. How did this product do? This life insurance product would have given you $544. What do you think about a product that says, hey, you can get this, you can get all the return of the stock market without the risk? The stock market's up to 49.21. This product's up to 544. Does that sound like you got all the upside without the downside? Doesn't sound like it to me. Sounds like you did a lot worse. So you would have been a lot better off, especially in the 90s. You can see in the 90s, you've been a lot better off. Now, granted, when the stock market crashed in the 2000s, this product didn't lose much money, did it? Kind of nice. But you gave up a lot in the end. But that's how they're advertising it. All the upside without the downside. What's wrong with that sentence? Which word bothers you in that? All the upside without the downside. All. The word all. Does that, if you said 15% of the upside without the downside, does that sound as impressive? Maybe not. All right, we're going to go through this article and kind of give it. So see what you did, Stefan. You got me ahead of the class, but that's fine because you're gonna have to listen to my my ranting and raving one more time on that one. Let me tell you, Dawn, this story. All right, this will close out the class. I want y'all steaming mad when you leave here, and then when you see your uncle that sells life insurance, he's gonna call me up and cuss me out, or he's gonna tell you your professor didn't tell you these things, and you can come back and correct me. That's fine. But I'll tell you Donya's story. So at my church, my pastor would call me with all this pro bono stuff to do. He would say, I got this lady in my office and she's in tears. Can you help her out? And I'm like, okay, what life insurance product did she buy? And sure enough, I'll tell you Margaret's story as well later. But Donya's story, sweet little old lady. Oh my word, sweet, hair in a bun. Sweetest person in the world. She got married early in life, did not have a high school education, got married, had a son, and soon after her son was born, her husband passed away. Single mother, not much skills. I don't know how she did it. Odd jobs, whatever she could do. She raised her son on her own. This incredible lady. Somehow she saved up $100,000, which to me is very impressive. This single mother without a high school education, she saved up $100,000. And she went to an insurance company that I won't name, but a very large insurance company that is domiciled in New York. But I won't tell you the name of it. She gave them all of her money. And they sold her a deferred annuity. They actually sold her a pretty decent product. Competitive, simple product, pretty simple product. Well, and then she turned 70. Well, the tax code says when you turn 70, you have to annuitize this product. It's tax law. You can't leave that product by because the IRS is giving you all this wonderful tax benefit and say that's fine, but when you turn 70, we want you to pay tax. So you got to start taking money out of this product. And so her rep says, Donya, we've got to take money out of this product or we got to pay the tax. And she doesn't understand any of that, which makes sense, right? She's a smart lady, but she's not a finance person. So guess what her rep does? He surrenders her annuity, making it 100% taxable. Every gain she's had on that product is now taxable. He puts it into another product. Guess what he got when he put it in another product? You may want to guess. He got a commission. I'm sure that didn't even cross his mind. Now, what could he have done? He could have annuitized her annuity. He could have just put it in payout mode and she would have just paid tax on a small portion of that. So this is a lady who hasn't paid tax in her life because she's never made any money. And now she's just discovered she owes the IRS $10,000. You see why she's in tears, right? This poor lady owes $10,000 and she doesn't have $10,000. They actually sold her another product. They sold her a life insurance policy. She didn't need life insurance, but they sold her a life insurance policy. She has one son. He's out of the house and he's independent. He doesn't need her. She doesn't have any dependents, but they sold her life insurance. I would have loved to have heard that sales pitch. So what did he do to help pay her the tax? He sold off some of that policy to give her some money to help pay the tax as well. Why? Because when he sold off the annuity, he didn't take out enough to pay the taxes and he bought another product. So he needed more money. So he sold some of his life insurance. Guess what happened when he sold some of the life insurance? That became taxable as well. So now she's got all these taxes to pay. She's in tears. She doesn't know what to do. So I say, let's go to your sales rep. I'll go with you and sit down. I come in. I'm generally a nice person, although some of y'all might not agree with that. I've had students say I'm real intimidating. Do I seem like an intimidating guy? I think I'm pretty lucky. I was an intimidating person on that day, intentionally. I walked in, scared that guy to death, and I did. I scared him to death. So he said, yeah, I messed up. Okay, you just admitted in front of me, you messed up. He said, I messed up because my company didn't train me very well. I said, okay, you admitted that in front of me, I'll take that. And it's like, okay, so it sounds like it's your fault. He says, yeah, but it's really not our fault because this was a tax issue. She should have consulted her tax attorney. Now, guess how many tax attorneys Danya has? She's never heard of a tax. She doesn't even know what a tax attorney is. So that was pretty irritating. So my thought is, I want to sue this company. This is a company that's been sued a lot, had lost a lot of lawsuits. So I'm thinking, this is a company that's already in bad trouble. That's what I want to do. I want to sue. Danya doesn't want to sue. She just wants the company to reimburse her for her taxes. And so I write a letter, and this is what you do with life insurance companies. You write a letter to the president of the company. You do a presidential complaint because the regulations require them to answer that. So I wrote the letter. They didn't reply, so I called them and they said, well, we don't reply on the first letter, so send it again. So I sent the letter again. It was a very lengthy letter. No cuss words because I don't use cuss words, but very intimidating letter. I called again and I got this lady on the phone. And she says, we decided to send her a check for $10,000. I said, okay, that's great. And she said on the phone, I almost had a heart attack. She said on the phone, we're only doing that because the sales rep admit he made a mistake in your presence. So they weren't admitting making any mistakes. They say, we're only going to do that because he said he made a mistake. Now, do you think he made a mistake? I think he absolutely did. Their argument was he should have just told her to figure out how to do it. And he shouldn't have done anything. It was her money, her tax problem, not his problem. I said that to some financial planners and like, yeah, but it was so obvious what he should have done. He should have just done it and been done with it. You know, they were like all irate that he did this to them. I said, okay, send us the 10,000. So they send the 10,000 with a form that says, if you cash this check, you're admitting that we made no mistakes, not only on this product, but on any other product that she has bought. Now I want to sue them on the life insurance as well, because they shouldn't have sold that. I'm saying you shouldn't sell this, Danya. We should sue the company and you'll make millions of dollars if you're rich. But I'm not a lawyer. So you got to make a decision. She didn't want to make a decision. She wanted me to make a decision. I'm not going to make a legal decision. So we went to a pro bono lawyer. And you want to guess what his recommendation was? It's a pro bono law to help poor people that need a lawyer. You might want to guess. I bet you won't get it right. What do you think his advice was? Take the 10,000 or sue the company. What do you think? No, he didn't say that. He didn't say sue the company. What did he say? This is a lawyer I'm talking about. What did he say? Pro bono. No, he didn't say that. Y'all can't guess. He told her to hire a lawyer. What value is it to go to a pro bono lawyer whose advice is you need to hire a lawyer? So I was like, Danya, it's your decision. I'm not going to make a decision. So I think she could have, I mean, if you saw her, you could just imagine her on this, you know, at the court. She's like the perfect person you want testifying. She was just been wonderful. And then I get up there and they all hate me because I'd be like a raving lunatic. But oh my word, when I was talking to the lady at the insurance company, I was like yelling at her, would you do this to your own grandkids? And then I even told her, I said, would you do this to your own grandmother? And then I said, I think you probably would if you got a commission on it. I was yelling, and the guy behind me, he emails me, Ron, everyone in the Bay is looking at you right now. It's like, oh, okay, I'll be a little quieter. I was so lividly mad. So I said, I can't decide what to do. I really wanted her to sue the company. I was tempted to say, hey, I'll give you $10,000. Let's sue. If you win, you can pay me back to 10,000. But her final decision was just give me the 10,000, I'll sign. But she kept asking me, but is that what I should do? And it's like, I'm not giving you that advice because you think she could have won that lawsuit? I mean, it's huh?
If the products are complex, imagine how hard it would be.
Oh yeah, they would have fought it pretty hard. Yeah, but they've lost a lot of cases, but it would have been interesting. I don't know. I had a really famous daughter of a very famous lawyer here in town in one of my classes. She said she actually took my class because she wanted to figure out how to sue businesses better. I was tempted to call her and say, would you actually take this case? But so she took the money, and she wanted to take money because she was going to Hawaii visit her son that she hadn't seen in some time, which is really good that she did that because her son actually passed away from cancer just a couple of years later. But that story makes me so lividly mad because no industry should treat their customers like that. And it was so simple. She bought a product. She bought a good product. The life insurance she bought, she shouldn't have bought that. That was a ripoff. But the annuity she bought was a good product. It was a product made sense for her. It was simple. They should have just annuitized it. She would have paid some tax on it, but it wouldn't have been that bad. She actually had her prepare her taxes for her that year. And I was like, I don't do taxes, but oh, you can do it. You can do it. So I couldn't tell her no for that, but I did do her taxes. Sweetest lady. This is the life insurance industry in practice. I'm not talking about some fly-by-night company. I'm talking about one of the largest life insurance companies in the world, not in the US, in the world. Well-known company. I won't tell you the name of it. Well-known company. I don't know if you want to guess, but you would have all heard of it. So that's the Donya story. How much of that is in here? The product complexity really wasn't in there in that one. I think the sales commission was in there. I can't tell you for sure he got a commission for doing that, but it sure sounded like he churned that product. He had no reason to sell that product. He could have just left it as it is and have it start paying out. So makes me angry. But anyway, any questions on that? How are you going to put this into the exam? You got to take all my ratings and you got to put it into your own words there. All right. But all the pieces are here. I didn't leave anything out. I even added this little extra piece. So think about this. Maybe, all right, Thursday, we're going to talk about Articles 3 and 4. Maybe next Tuesday, we should debate this. And some of y'all, any of y'all want to come in and debate the other side of this? Let me know. I'll let you have, you can debate it. So let me know if you think it's perfectly fine for life insurance reps to be paid commissions that differ significantly, product A to B to C. Come in and make your argument. I'd love to hear it. All right, I'll let you how much raving can you take in one night? So I'll let you out. Let's talk about the next two articles. So this first one, again, the key is start off with exactly what are they saying. They're saying something very, very, very important in this first article. They say it in the second article as well. This is a very neglected part of finance. William Sharp, I think I mentioned, this is the thing that William Sharp is working on right now. People are hitting retirement. You got all these baby boomers. You see baby boomers come up in both of these articles. So you just see it over and over again. All these baby boomers retiring, and yet the industry is not focused at all on how to take the money out. They're just still focused on accumulating assets. And you're going to see the word inertia coming up here. Inertia. We're just so used to savings for retirement. And now it's like, oh, I can't take money out. I've saved all this money, but I can't take money out. And it's like, well, why did you save all the money? Everybody's like, well, I want to leave it to my heirs. Well, then why were you saving for retirement? So that's big issue. You've seen some studies out there. Probably the most famous one It's a Trinity study. And it's changed over time. On withdrawal rates, it used to be 6%. They say you can safely take 6% of your portfolio every year and it'll last for the rest of your life. But that was based on inflation at a low level and stocks and bonds making you 5, 6, 7%. Bond market's not making you 5% anymore. So you can't use that number. I don't know what they're saying in this article. So now they're down to, they used to be the 6% rule. I think I saw this article somewhere else, the 4% rule. What does that mean? You can take 4% out of your portfolio every year. Now, what does the 4% rule mean? There's two ways you can interpret it. Let's see if we can think about this. So let's say you have $500,000, which is not enough to retire on. Let's say you think you can do it. So the 4% rule means the first year you can take 20,000 out. Let's say your portfolio makes 5%, but you took 20,000 out. So now you have 505. Does that make sense? I don't know why I have so many decimal places. I meant to go the other direction. So you took out 4%. And now you have $500,000 because you made 5%. So you made $25,000 on your portfolio, but you took out 20,000, you got 5 left. What does the 4% rule mean? Some people say, well, next year you can take 4% of that out. Then take 20,200. What's the problem with that? What's your inflation rate here? Inflation rate's 1%. Is that enough of an inflation rate when inflation is 10%? That's not going to work, is it? That's one interpretation. If you keep doing this, you can get these really small raises, but what if your portfolio, what if the stock market sells off? Now what do? My interpretation, I have to go back and read it. My interpretation of these studies doesn't mean this. And you really take a 24% hit. I think what they actually mean is you take that and every year you bring in inflation. So the 4% is your starting point, and then it grows with inflation. And you take that, and what they're saying here is if you do that, you should be okay. Boy, I hate that thing so much. You should be okay because your portfolio is still growing and you're making your inflation number. But here again, if you have a really bad year, you notice now your portfolio is actually shrinking. So what the Trinity study is doing is run a bunch of scenarios and say, if you start at 4% and you grow at that with inflation, will your portfolio last under different scenarios? A strong stock market, a weak stock market, high inflation, low inflation. That's what they're testing. What do you notice I don't have here is a 10% inflation all of a sudden. So it makes a big difference. To tell someone, you know, you just take 4% of your portfolio and you'll be fine. That's true, but if the stock market crashes, can they really take a 24% cut in their take home? Most people can't do that. That'd be nice. It's pretty obvious, you know, and then your portfolio gets down to portfolio has a huge drop. You say, no problem, just keep spending 4%. Well, of course, then you're never going to run out of money. That's pretty obvious. But no one can take a 79% drop in their income. So I really think what they're saying is you take, that's your starting point and you grow it with inflation. And if you do that, your portfolio should be able to last your lifetime. That's expecting different numbers for what stock returns are going to be, bond returns are going to be, what inflation is going to be. So they're bringing it all together. And I haven't read this current study to see if that's how they say. It went up to 30 years. but they are running scenarios. And it's pretty critical. So you can see here, no inflation doesn't really help you. It's not making much sense. They're running different scenarios on your stock allocation, 100% in bonds, 100% in stocks, and what happens over time. And your goal is to have nothing left when you retire. You don't want to leave anything for your heirs. So what do your heirs get? They win if you die fast. They lose if you live a long time. Is that fair? It's not their money. Who cares? You paid for their college. They should be happy. That could be the attitude. It's up to you to decide that. That's that bequest smart motive. And so they're running different scenarios. So it's a huge deal. It's really important. What withdrawal rate is safe. You tell people it's 4%. My interpretation, if you tell them 4%, all you're telling them is that first year of income. And then assuming grows with inflation after that. So if you can't live off of $20,000, then you didn't save enough. Now, is it actually 20,000? What is it really? It's 20,000 plus Social Security, plus any pension you have, whatever else you have. So you have to bring all that together. So we're going to talk about that. So what is this article talking about? Well, the Trinity study is assuming you do how much in annuities? They're assuming you don't do any annuities. They assume you leave all your money in a stock and bond portfolio. And so the question they ask in the studies is, when we do this analysis, what we've discovered is if you put a certain amount of your portfolio into an annuity, it's going to pay you income the rest of your life. You get a much better solution from a risk-adjusted standpoint. People should be buying these immediate annuities. So an immediate annuity is one that you give them the money and they start paying you a monthly income right away, and they're going to pay you until you die. This article, I think the second article makes a stronger point. You need to get this into your paper somehow. It's a tough concept, but that this ongoing guaranteed level income is a very good economic decision. The economists have looked at it and say you are better off from a risk standpoint. They're not saying 100%. They're not saying, hey, take this entire $500,000, go to Northwestern Mutual, put it all into an immediate annuity. They start paying you $2,000 a month. They're not saying that. We'll talk about what level they are talking about, but they're saying everybody and almost everybody should be buying at least something in an annuity. And we'll see that more in the second article than the first. So what's the annuity puzzle then? If the economics is overwhelming, people should be doing this. And the question is, why aren't people doing this? Because people aren't doing this. And that's the key on this first article, is to find what that annuity puzzle is and then try to figure out their solution. Why aren't people doing what they should and economically be doing? If we're rational human beings, then we should be doing it, but we're not doing it. Does that mean we're irrational, or is something wrong with this? Now, what's the big word they talk about here? Biases. They talk about the biases. We have biases on how we make decisions that make us make bad decisions. So this article, you need to talk about biases. And so I think I talked last time, biases. I talk about biases in 2 of my classes. I think I'm the only professor that talks about them, but we need to talk about them because it's becoming a really huge deal in finance. So the economists assume we are these rational decision makers. We always make decisions in our best interest, reasoned. And then the behavioralists come in and say, no, there are situations where we make really, really bad decisions that defy the logic, the rationality, and why is it? So we'll go through that. So this paper, I'll give you some of the biases that relate specifically to this issue, not all of the biases, but some of the major ones, okay? So this first article starts off with, people should be buying these annuities. And they're not. And we got to find some way to fix that. So if we can figure out why they're making bad decisions, we can then address that. They call it decumulating, because while you're saving for retirement, you're accumulating assets, and then you need to decumulate them. How do you convert what you've accumulated into a stream of income? But these biases prevent us from making the best choices. Now, you might say, well, what if it's not the best choice? What if they're wrong? So you're somewhat relying on them that they've done the statistics, just like in the first article, they've done the analysis correctly. They discover what the best answer is. And this article is saying, we know that, but we're not doing that. So what is the annuity puzzle? It's this annuity puzzle is simply people should be buying annuities, but they're not. Why is that? And that's what this first article is trying to address. Which means a big part of this first article is why are people not doing it correctly? And then the solution. Okay, that's pretty critical. Why aren't people buying annuities? Can we somehow address that so that they will buy annuities? Now they use the word pension here. Are y'all familiar with DB versus DC? What's a DB? Defined benefit. And DC, defined contribution. That's your 401k, 403b, etc. And then you also have your Roth, your traditional IRA, etc. So, and even your taxable accounts. So defined contribution, your employer is setting money aside for you. And then you have your Roth and your IRA and your savings that you're setting money aside for yourself. All of that money is exposed to markets. If the markets go down, you lose money. If they go up, you make money. But the defined benefit, it's a guaranteed monthly income for life. Social Security, corporate pension, your own personal pension. That's what we're talking about here, a life annuity. So you might say, well, my company doesn't provide a pension plan. So I've got Social Security, and what this article is saying, hey, you can create your own pension plan by buying a life annuity, and specifically a life immediate annuity. By immediate, that means you give them $500,000 and they suddenly start paying you monthly income right away. A deferred annuity is an accumulation product where you're putting money aside until you retire. That's just your savings. In fact, a deferred annuity comes down here. So remember with my Danya story from last class, they should have just annuitized her, which means they should have just put her into an immediate annuity and have the money start coming out. And then she'd only pay tax on the small part that's coming out. Instead, they sold it and bought a whole new annuity. So what the article is saying is some of this we still need, and the life insurance industry provides it, but people aren't buying it. In the past, they were getting a whole lot more of this corporate pension. And that's in the second article, especially. They talk about the demise of the corporate pension, which is something I'd be really impressed if in your paper, you would actually update that in your paper, because you can get much more current data on that. I think I actually found one. I don't know if I put it in the notes or not. I think I did. I think I did actually put it in the notes. All right. So why don't people buy annuities? And this is where you get into the biases. How is it the way people talk? So they talk through the biases here: mental accounting, prospect theory. When you see prospect theory, who comes to mind? Kahneman. Yeah, that's the Kahneman thing. All right, so let's talk through some of these biases then. So mental accounting is we segregate fungible things. That's one reason I don't like Dave Ramsey. He says put all these envelopes with cash in your house for different things. I just don't make sense to me. First of all, if you leave a Dave Ramsey conference, all these crooks are going to be following you home because they know you're going to have all these envelopes of cash sitting in your house that should be in the bank. But secondly, cash is fungible. You don't have to set aside your your food money from this and this. He's trying to make you more disciplined. I'm like, that doesn't make sense to me. But we tend to kind of think about this. This is this money for this money for this. And what happens is there's a solution where if you look at it in an integrated way, you have a better solution. But because you're doing everything in pieces, you end up with a very broken decision. Related to the mental accounting is how we view annuities themselves. And we're going to get into the framing here, so let me leave that. But prospect theory has to do with how we view gains versus losses. We tend to be loss averse. We tend to be much more aggressive when it comes to not losing money than we are aggressive when it comes to gains. Prospect theory is pretty obvious for most of us. We understand that. It may be the reason our government is such a mess right now, because our government, we'll talk about this a lot in health insurance, the government keeps giving stuff to people. And if they try to take it away, those people are going to fight like crazy. If they want to take it away so they can do something for somebody else, the people they're going to help are not going to fight very hard at all because they're gaining. But the person they're taking away from it, boy, they're going to fight like mad. We tend to be, and there's been studies, man, they're pretty, I think, pretty hilarious studies. He's done things like he'll have a group of students and he'll give half of them a coffee cup and the other half he'll give them a t-shirt. And then he'll say, hey, y'all trade with each other. And if people got a coffee mug, they're not giving up that coffee mug for anything. And if people got the t-shirts, they're not giving up that t-shirt for anything. That's mine. So that loss of the t-shirt was just meant so much. And I don't know why we're like that. I think airlines should take note of that, because I think they could do their when they get someone to give up their seat on a flight, is that a gain or a loss? It's a loss. What do people say when you ask them? I've been flights where they're offering like $800-900 to people who might probably make $15 an hour, and they say you can wait 2 hours and take the next flight and we'll give you $800. Like, no, there's no way I'm going to do that. That's prospect theory. They don't want to lose it. I think airlines should change the math and say, hey, you just won a $800 voucher. If you don't come within the next 5 minutes, you're going to lose that voucher. You got to somehow change it so they're losing something, and they'll think differently. And then they'll say, hey, I can't lose this voucher. You don't say, hey, well, you give up your seat. You say, you got 5 minutes or you're going to lose this voucher. That changes the way we think, even though it's the exact same question, isn't it? And so that's what prospect theory is. So, and that's important to this article. You've got to change people's way of thinking. If they're thinking about this, and this is where the framing comes in, the mental accounting and the framing. If they're thinking about this as an investment, then putting in an annuity, it's like they're losing money. They had $500,000, but they're going to give $100,000 to the insurance company for an annuity. They just lost $100,000. That sounds like a loss to them. You've got to reframe it in terms of you're protecting them on longevity risk. And so we'll look at that. Here's how he shows the actual math. We're much more risk seeking on the loss side. We're actually risk seeking on loss side. We'll do some crazy things. What he's shown, though, I think is really interesting to the framing side. He'll take a problem, and it's the exact same problem, but he'll express it as a gain terms the first time, and he'll express it in loss terms, even though everything's exactly the same, and he'll get radically different answers. One might be, hey, we got this drug. If we use this drug, we can save this many people, but we'll lose this many. Or he'll do it the other way, and it'd be the exact same math, but he'll change how he uses the words gain and loss, and the groups will have opposite answers on how they want to do it, just the wording. There's a famous book on this. I don't know if y'all have seen this book before. Any of y'all know Richard Thaler? Who's Richard Thaler? Any takers on that one? He's the father of, any guesses? Father of behavioral finance, which is what we're talking about here. I wasn't a huge fan of this book, but it's probably worth reading. It's only like $8, so why not? Politicians are using his thing. It's just how you frame a question can radically change what decisions people make. So rather than the government coming in and saying you have to do this, instead the government comes in and changes the framing. I mean, the most obvious one everybody knows about is organ donation. Don't have people opt in organ donation, have them opt out. So everyone's an organ donor unless you opt out. You'll have a whole lot more organ donations if you do that. Well, what do we do right now? You have to opt in. So we have a lot fewer. That's the nudge idea. You just change the equation around. And that's what this article is talking about. A lot of this is just how people approach the actual question here. And so that's prospect theory. If you can take the exact same problem and switch it from a loss equation to a gain equation, you can make people make different decisions. So that's why the framing is so extremely important. How we word the question will change how people make the decisions. So here's what they talk about in the article. The options worded or framed in turn of post-retirement consumption. So they say, hey, if you buy this annuity, you'll be able to consume much more of your income. You'll have higher income. People chose it. If they talked about it in an investment context, people didn't want it. So when presented as in a consumption framework, 71% that said they would buy it. When it's presented as an investment, 73% said they didn't want a life annuity. The exact same question, they just changed it from, hey, we're going to maximize your income versus, hey, we're going to take some of your investment and we're going to stick it in this annuity and you have no more control over it. That feels like a loss to them. And they say, no, why would I do that? Why? Because the next thing, or the last thing, inertia. They've been saving for retirement for 50 years. Don't tell me you're going to take $100,000 of that money. I worked hard to get that money. So they view it as a big loss of $100,000. That's that inertia. We're not comfortable with switching around our thinking. I think framing is probably the most important part, mainly when you get to the solutions, because the obvious solution, which a lot of students miss, but the obvious solution is reframe how you market these products. Change the verbiage that you're using. People buy life insurance because they're worried about dying too early. They should buy annuities. They're worried about living too long. But you don't state it in those terms. You talk in terms of, we want to maximize your income in your life, and this product will do it for you. Why don't insurance companies do that? Because remember, we talked last class, they're into this. I don't think I used the term last class, but you really want it in that ethics question. Asset gatherers, insurance companies have become asset gatherers. They're investment firms. And so they're so used to being asset gatherers, they can't really change their marketing to be insurers again. To say, hey, we're insuring you living too long. We're going to give you the maximum income you can possibly have out of this portfolio. So framing is a huge part of this first article on annuities. These others are interesting. The availability heuristic, we tend to be more sensitive to things that are recent, that we can think about. So taking someone's $100,000, they're going to think about, well, wow, what if the stock market was up 10%? I'm going to lose control. They're not thinking about what if I live to be 100, because that's not something available to them. That's not something that comes obvious to mind for them. The hyperbolic discounting is a big deal in global warming. You tell people 100 years from now, it's going to be really, really bad. Well, if your discount rate's high enough, 100 years from now is nothing. Jeremy Grantham talks about this. He says finance really can't handle global warming because it's so far out in the future. The present value of it is so small, it doesn't look like much of a problem. If your discount rate's really, really high, then something that's 20 years out, you don't care about it because you take it to the present value and it just disappears. So people do that hyperbolic discounting. They essentially make the distant future so unimportant because their discount rate's too high. And the annuity is shifting money from the present that's in your portfolio today. You can do with it and shifts it into the future. And people say, I don't care about the future. We tend to overweight certain likelihood of catastrophic events. So living too long is not a catastrophic event. You don't suddenly trip and fall when you live too long. So crashes, accidents, disease, our mind is much more akin to things that happen rapidly and suddenly, even though they're much less likely to happen, and our minds are more likely to happen. And then we saw this at USAA. We tend to combine events that are unlikely to happen. We combine them in as if they're likely to all happen together. I remember at USAA, we were talking about our worst case scenario. It was a 1 in 500 year event. This is a very, very rare event. We've had some massive hurricanes like Katrina. Katrina was not a 1 in 500 event. It wasn't even, I don't think, a 100-year event. We're talking something that happens. I mean, when it happens, you're going to know about it. I mean, it's going to be massive. I don't even think the Japanese tsunami was a 100-year event. So we're talking about something that's extremely rare and really large. And the executives are saying, well, if we had an event like that, I could see us having an earthquake later in that year. It's like, no, we're talking about a really rare thing. And what's the math that they're doing with conjunction fallacy? I should let the actuaries teach this, but the probability of A and B versus the probability of A given B. Are those the same thing? What was the math they're doing in their mind? The probability of A given that B's already happened. But B is incredibly unlikely to happen. So I'll say, what's the probability you get struck by lightning and bitten by a shark on the same day? And what they were saying, well, if I get bitten by a shark, I could see getting struck by lightning later that day. Yeah, but what's the chances? You haven't been swimming in the ocean in your entire life. It's unlikely you're going to. But that was the math they were doing. They were doing the probability of A given that B's already happened. And they're saying, wow, that's pretty likely. We do that because we're not very good at statistics. Not everybody's an actuary or decision scientist. So that's that conjunction. We're just combining things. But inertia is a huge one. We've been spending our whole life, and I think the insurance industry is a big part of this because the insurance industry now is so focused on saving for retirement because they make more money on those products. And so we've gotten people into that habit, and now the thought of taking any of that money out just horrifies us. And so we don't want to change that. We've been doing our 401k forever and ever and ever. I want to keep building it. So those are the ones. The one that's probably the most difficult to put in this paper is this prospect theory. You have to kind of combine it with the others, but do put them all in there. Now, there are other fallacies out there that are very, very important. So I'm focusing on the ones that are really related to this article, but make sure you have a section on these biases and you talk about each one, and you'll have to do some thinking how to tie it to the case. Probably the biggest fallacy is confirmation bias. That doesn't relate here so much, but it's a big issue for finance where we tend to make a projection. We get our ego invested in it. We tell our boss what we think. And then the rest of that week, anytime we see an article that agrees with what we say, we click on it and read it. Anytime we see an article that disagrees with what we think, we avoid it and say, oh, that guy's stupid and what he's talking about anyway. We tend to confirm our egos because that's what we do. That's confirmation bias. That doesn't really relate to this particular article. So there are other biases out there that are pretty serious. My favorite book on this that I do highly, highly recommend. Some of y'all know I pushed this book, Annie Duke, Thinking in Bets. Not her second book. I hate to say I didn't like her second book. But this, I think, any of y'all read this book yet? So I recommend it a lot. I'm thinking about emailing her and see if I can get her to autograph her book and send it back to me. Because she has to notice her sales have gone up in San Antonio. I keep pushing this book everywhere I go. So what does she do? She takes Kahneman, that's somewhat theoretical and not real practical, says, given these biases, what can we do practically to make better decisions so we don't fall into these biases? And she has some really, really good stuff in there. As I always say, her time travel to me is the best one. I love that. I do that all the time, and it really does make better decisions. But she has some very practical things that you can do. But the biases are important. They're important in these articles. They're important in finance because we see them all the time, making us make really, really bad decisions. So there's where she's talking about those biases. She does have a section, and I don't think this has to do with biases, but I would definitely try to bring it into your paper. Who's more likely to buy an annuity, a man or a woman? Do you remember that? See if you actually read the paper, but who's more likely to buy an annuity, man or woman? There was a difference. Huh? Women live longer. I don't think they said that was the case. I think they thought it was more in the decision making that men and women are slightly different. Women were found that have chosen annuity 38% versus 29% for men. Why is that? You can, see what their answer is to that. But what does it mean for the insurance industry? It might mean they need to make sure both spouses are in the room when they sell this thing. If only the husband's there and they say, hey, can your wife join us for this? So that may be part of their technique. Or, oh, my husband's at a meeting tonight. Oh, good. Well, let's sit down and meet before he gets back. Either one of those would work. It's not a huge difference, but there is a statistical difference between those two. All right, so what are the solutions? So the framing is probably the biggest one. The framing is related to training and marketing. So you need to talk about training. The employees need to be trained to get around these biases, how they market the products, how the company markets it, how the sales reps market it, and then how it's framed, how it's actually presented. And then they talk about this idea of new products. I'm going to show you a new product that I really, really like when we get into the pricing, when we talk about the benefit of survivorship. So I'm going to show you my product later that I keep hoping someone will go out there and create a company and sell it, because I think it could work. Their product they're pushing, it's okay, but you can talk through it. I don't think I would do a product with Jen Worth right now. I thought the Queen was still going to be the lead story there. How quickly we forget. So Jen Worth. So there's Jen Worth. Used to be a $36 stock. It's now a $4 stock. We're going to talk about Jen Worth. They sell one product more than anything else. I don't know if y'all know what they sell more of, but this is a long-term care company. Does that look like a healthy company? $4 stock off of 40. So it's definitely in 2008, it just nosedive. Try to come back. I was talking about them right here, and one of my students bought their stock right here. He was real happy. I don't know where he got out of there, but he was real happy because we actually thought it was overdone. The market was overreacting to it because it wasn't as serious. But we'll talk about why long-term care is just not a good business model. And then the last thing they talk about is the default option. So what's the default option? A lot of employers are doing this. This gets back to that nudge with Thaler. Rather than having people choose the annuity option, make it the default option if they don't choose anything else. It's kind of like the organ donation. All right. So there's 5 things there, aren't there? So we're talking about solutions. All right, anybody remember them? I'm assuming y'all can get it. Training your employees, understand the biases. It's hard to overcome biases if your employees don't know that they're there, aware of them. But
The way you present it.
okay, framing, the marketing, That's kind of two of them together, but what are some other ones? I just talked about Jen Worth. New products. Find other ways. I'm going to talk about one later, so you'll see. Essentially, what they're talking about, the new product, is combine products. So the immediate annuity is not so obvious. They're trying to get away from that you're losing money kind of thing and say, hey, this is part of a big portfolio thing. You're not losing, you're just making an investment that's more sophisticated, whatever it is. It come back to the framing again. The training and the framing are somewhat implied more than they're actually in here. So you'll have to just find that. And then what was the last one? Make it the default option. Default options have become a really big deal. I remember when I started at USAA on the 401k, the default option was like their certificate of deposit, low risk. So if you didn't make a selection, they put your 401k in this really low returning, low risk thing. And then the stock market was up, 10, 15% in the 90s. And people were like, my word, what's my money just sitting there? So what they did, when I was there, I was responsible for their 401k, and we went from 3 options to 13 options. And then they expanded that to many, many more. They added the life cycle options. So you had like the 2040 fund, the 2050 fund, when you're retiring, and they made those 2040, 2050 funds, that became the default option, which means young people are going to get a high stock allocation. Now, is that dangerous? Someone who doesn't choose, so you stick them in something that's 80% stock and the stock market crashes, are they going to sue you? Those are the kind of questions. They're probably not going to sue you. Why? Because courts are probably going to say that's prudent. That seems reasonable, that you weren't negligent in having them do that. You could get sued the other way. You put them into something too conservative as the default option. And 10 years later, they say, hey, I could have been up 10% and I only made 2%. I'm going to sue you because the default option was too conservative. So either way, on the default option, you've got some risk. So can you make the default option to select an immediate annuity? Some companies are starting to do that. They just automatically say, hey, at this point in time, when you turn this age, you're suddenly going to start getting an income unless you choose differently. Now, I don't know how they warn them. I think it'd be kind of shocking to people that they're suddenly getting a $500 a month check. Like, wait, what is this? It's coming out of your portfolio? I don't want to do that. I think it's been interesting to see how this actually works. Okay. So marketing, sales tactics. I don't know how to spell tactics. I do know how to spell sales, but is there a C in there somewhere? Right, so these may not all, the last 2 are very obvious because they have their own section in the article. The first 2 are somewhat implied. You just have to kind of read between the lines to see them. This is not the most exciting paper, but it does have some interesting stuff in it, and it's still true today. So here they even mention the marketing information. So, all right. What questions do you have on that first article? It's not a particularly difficult read. All right. No questions. That's good. I love perfect papers when they come in. All right, David Babel, one of my favorite people here. Let's look at the rubric real quick, just to make sure we didn't leave anything out here. Define the annuity puzzle. Economics says people should be buying immediate annuities, but they're not. Define longevity risk. Pretty straightforward. It's the risk of what? living longer than expected, much longer than expected. It's the risk of living too long. It's becoming a bigger problem because there are all these baby boomers. So there can be a lot more people that are living too long. And these baby boomers have been used to accumulating assets. Now they need to start drawing their assets. They're just not used to it. So that word inertia. Inertia kind of comes up twice here. It's one of the biases, but also I have it here separately because it's just such an incredible part. I don't know if y'all caught this on financial planners. It's in the article there. But they mentioned that financial planners take people's life expectancy, add 5 years, and they say, hey, we need enough money to get you here. So if your life expectancy is 85, they say, hey, let's just assume you die at 90. But remember, you got a 50% chance of living past 85, which means you got a good chance of making it past 90 as well. So is that the best solutions? When you get my age, you'll probably start doing what I've been doing. I see someone who's passed away, like the Queen, and I'm always interested in her age. She was what, 96? And then I'll see people, someone died at 82. And I'm thinking, okay, I got 12 years, I got 22 years. You know, I'm thinking, you know, he died because he drove 300 miles an hour. I'm not going to do that. So I ignore that one. But when you get my age, you start noticing when people are dying because you're like, you know, okay, how out of shape were they? And when you get my age, the one thing you really notice, I saw this the other day, there was this picture of this guy, his mugshot. Oh, this old man. He was ancient. Until I saw his age. He's my age. I'm looking at this incredibly old man, and he was my age. Now, it was his mugshot. Maybe we don't look all that good in mugshots. I don't know. I was like, there's no way I'm that. And your parents are going through that right now too, right? They're talking to someone and they're thinking, oh, this guy's, you know, older than I am and we're the same age. So you start thinking about that. We're getting, you know, I'm getting up into that 60, 70 years. How long could you live? You start thinking about how long your relatives live and those kind of things, but we really don't know. You know, you might say, well, my grandfather died at this age, but he died at something that people aren't dying from anymore. People were dying from diabetes in the 30s and 40s, and there was nothing to do about it. Now they're living with it, and we're living with these chronic illnesses. So you can't just rely on that because there's things we're getting past now. So how do you handle this? The annuity says just eliminate it. Find something that pays you no matter how long you live. So that's why it's that solution that overcomes this. And then a big part of the article, if you look at this as percentage of the overall article, it's the biggest thing in here. It's the biggest item on this article. So what are those biases? And then the solutions. I gave you the 4 solutions. So that's that second article. All right. Any question? Y'all, anything on that list is still confusing? Like, what is he looking for?
They handle longevity risk. How do you pronounce it?
How do you what?
How do they handle the financial planners?
Oh, financial planners. You come in and they say, okay, your life expectancy is 85, so let's assume you die at 90. They just add a few years to your life expectancy.
And then they just got payments.
Well, and then they say we got to make sure, like the Trinity study. So we'll start off with a 4% distribution, grow that with inflation, and that should last to 90. What they should be saying is, you know, but there is a chance you'll live to 95, 97. Let's make sure we have at least some of your income that's a guaranteed stream, like Social Security. All right, Social Security, your Social Security is going to be $30,000 a year. Why don't we add another $15,000 to that with an immediate annuity? So you got 45. So at least if you make it to 96, you got 45, and Social Security is going to make it for inflation. So and we're going to see that in this next article. How much should you annuitize? And their argument is make sure you got at least your basic living expenses covered with the annuity. All right. Financial planners aren't thinking that. They're saying, hey, let's assume you die at 90. Let's run the Trinity study. You can spend 4% of your portfolio. It should make it to 90. You should be good. Then just make sure you die at 90. That's not always the best planning. But the annuity takes care of that because it makes sure you have that income. I don't know exactly how they worded it, and I just deleted the article. But it's just one little sentence that they throw in there, so it's not a long discussion. All right, I like this article better, maybe because I like Babel better. It's a little bit more kind of financial. One problem with this article is it's a bunch of lists. Some of the lists are so obvious, you can just list them and you're done. Some of them you need to add a little more discussion, so you'll have to kind of think about that. So the first thing he says is, or they say is, we have a really horrible perfect storms here. So you got to talk, what are those things to make it a perfect storm? So here you do want to discuss more. You probably want to bring some of these graphs in, and then again, if you can find an updated one of these graphs, and some of them are pretty easy to update, then bring that in as well. So the first one is Social Security just cannot keep going like it is. It's a Ponzi scheme, and we're paying people too much versus the system. I keep seeing this stuff on Facebook. I don't know where they're getting this from, but it's this idea y'all probably see on Facebook. I know a lot of people on Facebook that are omniscient. They've got it all figured out. I'm not that smart, but there's some things they're putting on I don't think are right. I know it's hard to believe. There could be stuff on Facebook that's not true, but I've seen it so many times of Social Security is perfectly fine. Our government just needs to stop stealing from Social Security. Social Security has this trust fund, and our government just keeps taking money out of it. It is true, Social Security has IOUs from the government, but it's still their money. And when those treasuries mature, it's going to go back to Social Security. They still have the money. It's not like our government's taking Social Security money and building bridges. They're spending, $20 trillion more than they have. So they're stealing money from the future generation. But Social Security has treasury securities. They're no mature. They got the money. They still have the money. So that's not the problem with Social Security. The problem with Social Security is it's paying out more than it can possibly fund over the lifetime. And so because of that, the return on Social Security is coming down lower and lower and lower and lower. Remember that I told you about that first lady? I should have found her. I'm sure you could just Google the first recipient of Social Security, because she lived a long time and had a really good return on her money, because she made very few contributions and suddenly she started getting all this income. So we're getting, if you look at Social Security as an actual investment and you look at your return on capital, it's a very, very low returning investment. You're probably not making inflation. I've heard a lot of people say we got to take the cap off of Social Security so that wealthy contribute more. I think that makes it worse. I always had the cap when I was at USAA, because the cap, I was getting paid pretty well. But if they put the cap on there, what else are they capping? They're capping my benefits. If they take the cap off, are they going to take the cap off and make me contribute more, but still cap my benefits? Because if they take the cap off on contributions, but they also take the cap off on benefits, wealthy people tend to live longer than poorer people. So you're giving more benefits. The people are probably going to live longer. I think what they mean, I'll have to go listen to Elizabeth Warren and her arguments. I think what they're saying is no cap on Social Security. So once you hit the 100 and something thousand, no, Medicare doesn't have the cap. You keep paying Medicare no matter how much you make. Social Security has a cap, but then you cap the benefits. I think what she's saying is don't put a cap on how much they pay in taxes, but keep the cap on what the benefits. Yeah, that would solve the solution. Anything where you take more money from people is going to solve the solution. I mean, solve the problem, but what are y'all assuming for Social Security? Anyone here assuming zero Social Security? Do you think it's going to be that bad? And y'all think you're not going to get anything? I mean, what do we know about baby boomers? What are they going to do? They're going to vote. What do we just talk about with Kahneman? They're going to be extremely loss averse. Right? I still remember when I got out of high school, Ronald Reagan proposed some cuts to Medicare. Oh my word, there was a run of Cadillacs on Washington, D.C. I thought it was pretty hilarious. These extremely expensive Cadillacs were all on 16th Avenue protesting the cuts in Social Security and Medicare. They're not gonna let you get away with it. So they're gonna take you to the poorhouse and they're gonna keep their Medicare and Social Security. The question is, will they leave anything for you? Probably not. My generation has been horrible in financial stuff, so probably won't be anything left for you, but we'll see. I think you'll probably have some Social Security, but I think Medicare is going to be so default defaulted. I don't think there's any solution there. So Social Security's contributions, the richer you are, the less your return is going to be. So it is skewed toward the poor. What I would like the adjustment here, I've never seen this. I asked the actuaries at USAA this. It is true Social Security is skewed toward the poorer people, but we also would think that poor people have a shorter life expectancy, wouldn't you? They're more likely probably to drink and smoke, you would think. Kind of makes sense. If they have horrible jobs, they're probably just going to say, hey, I got to have some enjoyment here in life. So, if their life expectancy is 5-10 years shorter, then, there's a chance that offsets this entirely. So I don't really, can't say for sure. This is not adjusted for that. This is just saying, hey, if these all live the same length of time, poor people will have a higher return than wealthy people. The next one is the demise of DBs. This is the one you could actually find a chart on the internet. Let me see if I actually put it into our class notes because I remember doing it. No, I guess not. Boy, I sure remember doing it, but now I don't see it at all. Yeah. All right. But you can find this. So you just do DB versus DC in Google and you'll find it. So DB plans are very, very popular. And the reason they're so popular is that interest rates are rising, the stock market was doing well. Employers, their pension plans were like profit centers. The way the accounting worked, their pension plans were like making them money and they loved it. And then suddenly the stock market crashed and interest rates came down and suddenly pension plan, and they changed the accounting of pension plans. If any of y'all took my risk management class, we talked a lot about it. I don't think any of y'all were in that class, were y'all? Oh, you were in there. Remember we talked about that whole demise of pension plans. So employers, the accounting just got horrible for employers. They started shutting down their pension plan. When I was at USAA, I fought hard for us to keep our pension plan. I thought it was a really good plan. And so I hedged it so that you wouldn't have all the risk and just make it much safer. But our CEO is like, no, I'm getting rid of it. We're shutting it down. So there were 175,000 plans in 1983 at the time this article is written, which has been quite some time. There's a lot fewer. Most of the pension plans today are in the public sector. It's teachers, it's firemen, it's police. That's where the pension plans are. It's not IBMs and USAAs. HEB might have one, who knows? AT&T probably has some. Sometimes on the private side, like an AT&T, you'll see pension plans when they still have a heavily unionized workforce. It's more likely there than it is in other places. Under traditional pension plan, the retiree receives a set monthly income, which is what we're talking about in that annuity puzzle, right? Something that pays you an income for the rest of your life. Under defined contribution, the amount of income is going to depend on how much you saved and then how you bring the money out at the end. There are no guarantees. The risk for retirement has been shifted from the employer. The PBGC is the federal government that insures pension plans. So we've shifted longevity risk away from the employer and the PBGC, and we've shifted it back to the employee. The financial risk of retirement has been transferred from those best able to bear it to those less knowledgeable. And boy, I saw this one lady I was helping at USAA. She had a 401k plan. She had worked at USA for 30 something years. She should have had $500,000 in that 401k. She had $40,000 in it. It's like, how can you have so little money? But she had a son that had some issues and she was taking money out of that. She kept taking money out to refurbish her house. She's like, I can do that again. I just had to do this one time. And by the fourth time she did that, I was like, I don't think you can keep your hands off the money. But she had a pension plan that was worth over $500,000. Good thing. Do you think she was going to retire with $40,000? But she had this pension plan. Why did she have the pension plan? Because she couldn't touch it. It was USAA contributing to it. She didn't contribute anything to it. It was just sitting there. There was a lot of people that had a pension plan, didn't even know they had it. I was talking to my brother about that. I said, you've got to have a pension plan somewhere because he's in a very heavy unionized. He says, no, I don't have that. I said, you've got to have one somewhere. He's a smart guy, so he probably doesn't, but I hope he has one that he's not aware of. So you could find a chart that just shows you, and you'll see it. You see 401k plans going up like that, pension plans coming like this, and yeah, DC plans is the most likely. All right, this is just like in the third article, aging of the baby boomers. That's an issue that is a big deal here. That one's pretty straightforward and obvious. Now he talks about the post boomers. So these post boomers, there was this little lull, I don't know, in the 70s or so, you know, everybody was a flower child and all this kind of stuff. And there was a lull in people having babies. And then there's the echo generation, where the baby boomers started having kids. So you had this kind of this lull. And so what's happened with this post boomers is they have kids and they have parents, and they're being asked to take care of both sides. They got to take care of their kids and they got to bail out their parents that aren't ready for retirement. And so they're this kind of sandwich generation. And so this, have y'all heard the dependency ratio? Does that sound familiar? Investopedia. How many dependents you have, and counting dependents is both children and parents. So how many people are relying on you? We're not having as many kids today as we used to, but you're having to take care of your parents. And the question is, how many workers are there to retirees? And how is that number shifting over time? And you can probably find some pretty good charts. I think this is one, the article actually gives us a chart. So number of 65-year-olds per 100 persons, you can see a large increase. Is this only in the United States? Absolutely not. It's true in China, it's true in Japan, it's true in Europe, probably even worse in Japan and Europe than it is in US. You always hear, you know, there's more adult diapers sold in Japan than baby diapers. For just getting older and older and older. But the other dependency ratio is not just the percentage that are boomers, but how many retirees are there versus workers. And the way I like to think about it is like this. So you go graduate high school at 18, college is 18 to 24, right? Because it takes you forever. You work 24 to 55, then you're retired 55 to 95. So your working years, how many working years do you have there? 31. Dependent years, how many do you have of those? 64. Is that possible? Can we spend 31 of our years working, productive, making money, and 64 years dependent on our parents or dependent on Social Security? Can a system survive that? So does it work better if we make it 65? 41, 54, still pretty skewed. This wasn't a problem in the past. Why wasn't this a problem in the past? When 65 was selected as the retirement age, life expectancy was 65. People were retiring when they're dying. And retirement was for those people who just happen to live a little bit longer. And in fact, you may not realize this because there's no people alive anymore to talk about this. You talked about retirement back then and people got really mad. Retirement was telling people you're no longer useful, you're useless, get out. It was a very negative thing. It's not a negative thing today, is it? We have these commercials with people on the beach and they're all happy. But when retirement first was said at 65, people were mad. Don't tell me I can't work after 65. I'm still useful to society. I can still contribute. But now it's like, hey, I'm going to get out at 55. So it used to be, you went to school until you were 15 and you worked from 15 to 65 and then you died. You were working most of your life. In fact, in the farming community, you might have started working at the age of 7 and you just worked until you died. So there was no such thing as retirement. It'd be interesting to go back some of those famous fictional novels and see when the word retirement first started showing up. They may not have showed up before the 20th century. It's just not, I don't know, you go back to some of the ancient texts. Did Aristotle talk about retirement? Did Socrates talk about retirement with Plato? It's a very, very recent thing. Why? Because we're living much longer and we're healthy. We want to do it and we're wealthier. That's the other thing. You couldn't really even think about it back then when people didn't have any money. And then the obvious one, but is important in both articles, we're living longer. We are living longer, definitely living longer. He has a table of life expectancy. Now, we do know life expectancy has declined in these last few years. So, but one thing to be aware of, the decline in life expectancy is skewed. It's not that everybody's living shorter. There's a small segment that's living much shorter because of drugs and COVID and other things, mainly drug use. I don't know anything about drugs, but codeine, whatever's the one, I don't know what they are, but meth, I don't know what meth is. I never watched that TV show, whatever that was, the guy who was selling it, but none of that makes any sense. Anytime I see Law and Order and it's a drug gang show, I always click off of it because that world makes no sense to me. It's like, but people are declining, but everybody else is still living longer. People are still living longer. So it's a skewed, you have a small group. And in fact, historically, the reason you're seeing this really huge increase, this one here, life expectancy, but the reason you've seen a large increase in life expectancy the last 200 years, most of that is driven by infant mortality. People are making it to year 1. Once we got past infant mortality and extended that increased life expectancy quite a bit. So even that was fairly skewed. There's still a lot of 65 and 70-year-old people. It's just that when you average in a bunch of people dying at week 1, week 2, life expectancy at birth is much, 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 much higher today than it was back then. So that's a huge part of it. And that's not changing as much as it used to be. Infant mortality rates have somewhat stabilized in the world. So you're not getting that benefit anymore. People are smoking less, drinking less. That's true, but we're also eating more. So we have some other issues. We're not exercising as much. You've got a lot of things going on. You're going to talk about that when we talk about paper 2 with health insurance. And so, yeah, people are living longer. So what is an annuity? It's something that pays you an income for a lifetime. There's a subsidy. People who die early subsidize the people who live too long. Here he talks about your probability of living. You got a 25% chance of living beyond 97, especially if a couple that are both 65, there's a 25% chance that one of them is going to live a very long time. 25% chance. That's anyone going to say 25% chance. Oh, that's such a low probability. I'm not going to. If you're going skydiving and they say, hey, we lose about 25% of our skydivers. Oh, that's such a low probability. No, you're not going to do that. It's a high probability. You got to plan for it. And so here, I think they actually explain the economics of it better here. If they choose a life annuity, they will be able to spend at the same rate, but be covered as long as they live. Essentially, what they're saying is if you want to maximize the income in retirement, do an annuity because you can freely spend the corpus. If you don't do that, if you're going to live off your portfolio, you're scared to spend the corpus because the stock market crashes or you live too long, you have a problem. But when you buy the annuity, you can freely spend that money. You don't have to worry about it. So you get to spend more of your money. You're not clinging on so much of it. And that gets back to that third article. This is the way to maximize your happiness in retirement because you can more freely spend your money if you have an annuity. All right. All right, let's stop there. I'm gonna start here on the next class.